Hello friends, my name is Abhishek Mishra. Today I'm going to talk about Mutual Fund Distributor Certification Examination Chapter 1, which is about investment landscape. Let's start from the first slide. On this slide, we are covering what are the factors to evaluate investments. So there are two type of factors. One is the primary factors, which are most important one, and then there are certain secondary factors. So in primary factors, there are three main sub factors. One is a safety, one is liquidity, and third one is a return. So safety means how much one's capital is safe when a person is investing in that particular investment avenue. So, for example, equities could be a bit riskier, debt could be a bit safer, but again, it doesn't mean that they are absolutely safe. Government securities could be far safer than any other, investment avenues. So, safety is one of the criteria to figure out how investment is, how that particular investment is for a given person. Second one is liquidity. Liquidity means how soon or how easily you can withdraw your capital from the given investment. For example, real estate as asset class, it has a very low liquidity, because if you want to liquidate your capital or whatever you had invested in past, you have to find a buyer for your investment, and you have to agree the terms and conditions and the price, and the whole transfer mechanism itself takes a lot of time. So the liquidity is another primary factors for that purpose. And some of the mutual funds, and especially the liquid fund, or money market funds, they have a higher liquidity. So if someone is looking for parking their money for short term, they can look at liquidity as one of their key factor for investment. Next come to return. So I think this is one of the criteria majority of people look for, that how much return they are being offered for a given investment. So returns are not always guaranteed in all sort of investment avenues, but it's one of the core criteria for evaluating investments. Then comes secondary factors. Secondary factors, there are four pointers here: convenience, ticket size, taxability of income, tax deduction. So convenience is how easy it is to do investment. For example, if you want to buy a mutual fund, or maybe a any type of mutual fund, it's very convenient. You can go to AMC office, fill a form, and do it right away, or you can do it online these days. It's very convenient. But at the same time, if you want to, for example, buy real estate as an asset class, you have a paper options as well, in form of REITs, and in form of fractional investments. But at the same time, when you are going to physically buy a real estate piece and you want to keep that as an investment, it is not that convenient, because you have to look for real estate as a physical assets, evaluate it, then find a right price, and then do the transfer, and all the registration process, which itself is not very convenient. Next is ticket size. Again, I will take the same example. For example, mutual fund ticket size may be very small, like 500 or 1000 rupees you can invest, and there is no maximum investment limit in that. But in case of for example, real estate, you have to have a certain minimum amount, maybe in lakhs or crores, depending upon the type and the size and locality of that particular real estate piece. And maximum investment is also sort of limited, because then you have to buy multiple real estate investments. For example, if you want to buy let's say you have a lot of money, so crores and 50 crore, 100 crore, but you want to invest into a residential property, so you might find something very good at in 2 crore or 1 crore and 5 crore. So there is a limitation that you have to buy multiple units to invest your whole amount. So ticket size is one of those factors. Then comes taxability of income. So it depends how the income generated from that investment is going to be taxable. For example, just long term capital gain tax on the equities, if you hold them for a year, you have to pay 10%. But at the same time, let's say you are investing into fixed deposit of a bank, and you are already in the 30% tax slab, so you have to pay 30% income on the your FD income. Next come tax deduction. Tax deduction is, for example, if you have invested into mutual funds or shares and you have not realized any profit, then what will happen? You won't have to pay any tax on it. Okay, there would be no tax deducted unless you sell it. But at the same time, if you have invested, for example, into a asset class where there is a return coming every other uh, quarterly, yearly, you have to pay taxes on it. So these are the four secondary factors. Let's talk about various broad categories of asset classes. So if we see, these are the only four broad categories, and they every other sub asset class falls into this. Okay, so for example, real estate is a one. Sorry, I mentioned real estate factor, it should have been real estate. So you can buy real estate both in financial form as well as physical form. Physical form means you can actually buy a real estate building or flat or shop. And financial, that means you can invest into real estate company or real estate as a investment trust. So and that's a one. The second is commodity, all type of commodities, like maybe agricultural commodities, or it may be gold, silver, or any naturally found element. Then comes fixed income. Fixed income is nothing but it's type of debenture based, or you can say sort of government, sometimes government also issues bonds. They are nothing but debt. So fixed income is another asset class where you are paid out in form of coupons, which is interest rate, and it's only in financial form. And next comes equity. Equity is the ownership based, and it's only in financial form. So these are the four broad categories. So you find out any sort of asset, sub asset class or investment avenue, they will fall into one of these. Okay, let's move to the second slide. Comes investment risk. So these are a few types of investment risks that are predominantly in the investment space. Inflation risk. For example, if you have invested into a fixed income avenue where the interest rates or the return generated are in very low, so if it is lower than the general inflation, your purchasing power of money will go down. So what it means is that today, if you have invested 100 rupees and inflation rate is 6%, and 5 years down the line, and you have invested into for example, liquid mutual funds, and somehow let's assume that for each of those 5 years it has given 5% return. So that means you are earning less than what inflation is eroding. So your actual purchasing power 5 years down the line will be less than what it is today. Next comes liquidity risk. So there are certain asset classes where there is a liquidity risk. You cannot access your funds or the investments. For example, if you have into asset class where you have invested into real estate, you want immediate money, so you're not able to sell it. So that's a liquidity risk. And liquidity risk could be in all these asset classes. Like in equity, you hold a particular share and you want to sell it on the stock exchange, but there is no buyer for it. So that's a liquidity risk. Next comes credit risk. Credit risk is only for the fixed income or debentures where you have bought a sort of debenture of a company whose credit risk is very much it has been realized that it has defaulted on its payment. So you might not able to get your money back because the company or entity which has issued such debentures, they have lost the capacity to repay your money. So that's a sort of credit risk. Market risk and price, these are nothing but your investments is associated with a particular price of investment instrument, and if that price goes up and down, for example in equity space, your price can go up on a given day and can go down also. So such a risk, when you are going to sell it, if you need to sell it and the price is low what you had bought it, then you are in trouble. That's called market risk or price risk. Next comes interest rate risk. Interest rate risk is only generally applicable for fixed income or debentures. So if you see this way, let's say today's interest rate on a 10 years bond is 7%. Okay, government bond is 7%. But you have invested in for 10 years. Now 2 years down the line you need that money, you want to come out of that investment, so you are going to sell your government bond in the secondary market after 2 years. Now in the secondary market, or 2 years down the line, the interest rate itself has increased to 8%. So now you want to sell your 7% government bond to someone, but why that person will buy your 7% government bond in, why not he will go for the 8% which is in the primary market? So he will say, already this 8% government bond is already available for me, I won't buy your 7% because it's a 1% loss for me. So in that case, your price of the existing bond, whatever you own it will drop automatically. Okay, so that's the interest rate risk, and it can be in your favor also. For example, today it's a 7%, tomorrow it goes to 5%. So you are going to sell your 7% bond in the market. That means you are transferring to this, you can transfer this 7% interest rate to someone which is more than 5%, which is current market rate. So someone who's going to buy your this debenture or government bond, he will earn 2% extra. So for that purpose, the price of your bond will also increase. So you will have a capital appreciation as well. So if you see in simpler terms, when interest rate risk, when interest rates in the economy are expected to rise, or if they increase in future, for existing bond holders, the price will go down. So you have to remember one thing: interest rate increase are always inversely proportional to bond prices. So if in market interest rates are going up, that means the bond prices of the existing government securities or debentures or private debentures, they will go down. So they are inverse relationship. Then comes asset allocation. Asset allocation is nothing but investing people's money across various assets in order to achieve a particular objective. For example, everybody can have different asset allocation. Someone who is very young and can take a lot of risk, one can go for more allocation towards equity and less towards bond, and some exposure to gold and commodities. While someone is at very late stage, for example 60 years old, retired, and he or she will have to have a more debenture or fixed income asset allocation. So there are two types of it, and there is a third one, you can call it as its type, or it's one of the sort of component. The first one is strategic allocation. When the asset allocation of a person is aligned to the financial goal of that person, that is a strategic asset allocation. And tactical asset allocation is when there is a market opportunity and you can to benefit out of those market opportunities. For example, if equity market is down, but your target equity allocation is, let's say, strategic asset allocation is 40% and 60% is into debt, for in this example. So now equity market is at 30 or 40% down, but you see an opportunity. So you can tactically change your asset allocation from 40% equity to 60% equity, right? And when the same equity market comes back, you have made some money, you can rebalance your portfolio to bring your asset allocation from 60% equity to 40%, which was your strategic asset allocation. So every time you have made money, or your asset allocation has changed, periodically keep on rebalancing it. Let's move into behavioral biases. There are 6 type of biases here I'm talking about. I'll do them quickly. Availability heuristic. That means whatever comes to your mind first, relying on that and making those sort of information to take a decision. That is called availability heuristic. So there could be hundreds of possibilities, hundreds of experiences of different people, but what you are relying on, what comes to your mind first, right? So that's the availability heuristics. Always remember, behavioral biases are not very healthy. You have to always look at the broader picture. Then comes confirmation bias. So confirmation bias is that I believe in something and I will find a reason to confirm that belief. For example, if I believe that equity market are the only way to give a superior return, I will always look for such signals or information that will confirm my bias. Okay, that may not be the right thing again. Familiarity bias. Familiarity bias means this is a tendency where a person is going to invest his or her money where he is familiar. For example, if someone is not very familiar with the equity as a stock market, but one is very familiar to the gold, so he or she will keep on investing into the gold or into the government bonds or anywhere else where he is familiar. So familiarity bias is this sort of tendency. Then comes herd mentality. Herd mentality is following everybody else what they are doing. For example, when there is a market, stock market is going up, it's a boom time, so everybody start opening new bank demat account, they are buying those stocks which everybody is chasing. That's called herd mentality. Following the herd means following the crowd. Overconfidence, that's another bias where a person is overconfident in its abilities or judgment. Then next is recency bias. So many times people use the recent event for decision making. For example, as of today in 2024, people who have seen the returns last 3 4 years, it was because of the COVID downfall. But whatever returns they have seen, they assume that this is the return they are going to get in future also. That's a recency bias, but they do not remember that in long past there have been scenarios where the market hasn't been performing at all, it has always been flat or it has gone down. In such cases the returns have been sometimes single digit or negative as well. Next come risk profile. So risk profiling is very necessary when you are working as a mutual fund distributor or you are working as a financial planner. You need to do a risk profiling of a customer, because risk profiling will decide where your investors' money should be invested. So there are three factors to it. First is whether there is a need for the customer to take risk. That's one. Ability, whether that customer or investor is in in a situation where he has ability to take risk. And the third one is a willingness. So always remember, need, ability and willingness of taking risk is what decides the risk profile. Now it's time to go for some of the questions. So the way I have prepared all these videos, I have put in the first chapter itself, I have prepared both into one particular slide or one video. But going forward, first video is for the conceptual clarity and the second video is for the some questions and answers, so that whatever concepts you have learned, you should be able to answer questions related to that. Let's move to first question. The most important and primary factors to evaluate investments are convenience, ticket size and scheme name. First thing first, scheme name cannot be a criteria. So whether it's a primary or secondary, it's not a criteria at all. So first is out. Second is safety, liquidity and returns. These are the only three primary factors. So the answer is option 2. Third is taxability of earnings, availability of product, scheme of type. So scheme type is not a criteria, any criteria to include evaluate your investments, and all of these are incorrect because first and third are wrong. So option 2 is correct here. Next, move to question 2. The 4 broad categories of asset classes are real estate, commodities, equity and fixed income. The answer is option 1, because these are the only 4 broad categories where all type of investments will fall into one of these. Now let's look at the option 2, mutual funds. Mutual funds are nothing but they can be come under equity or they come under fixed income. Gold is nothing but they can come under commodities as well as equity. Real estate can come into equity and as well as come under real estate. Then comes option 3, shares. Shares are part of nothing but equity. FD is nothing but part of fixed income. Derivative is nothing but part of equity or combined feature of fixed income, and gold is nothing but it's type of commodity, or it can come under equity. So option 1 is the correct option. Arrange the following in their order of decreasing liquidity: liquid funds, land, physical gold. So remember, out of these three, land is the most illiquid. So land should be the last. So option first and 3 cannot be there. I have to write decreasing liquidity. So which is the least, which has the least liquidity will be in the last. So option 2 or 4 could be correct. Now let's look at option 2 and 4. First says physical gold is more liquid than liquid funds. I don't think so, because physical gold, you have to again find your gold. If it is kept in locker or in your house, take it to the shopkeeper and give it to him, and then you'll get money. Liquid fund is, you are again there also, you have to sort of go to the MC office, or you can do it online. But generally liquid funds are considered more liquid than anything else. So correct answer is option 4, liquid funds, then physical gold, and then land. And this is the decreasing order of liquidity. Which among the following doesn't offer regular income? Real estate, yes, it offers in form of rent. Physical gold say you don't get anything out of it. So the option 2 is the correct answer here, because physical gold doesn't offer regular income. Third is stocks. Stocks offers you dividend. Debentures offer you interest rate, which we also call as a coupon rate. The purchasing power of currency changes on account of which of the following? Asset allocation, rate of return, inflation, inherent risk. So if you have 100 rupees today, if you keep it somewhere safe in the locker or in your Almirah, and 2 years down the line, or maybe 5 years down the line, if you go and buy something out of that 100 rupees, the same quantity which you are going to buy today, the quantity you will be buying 5 years down the line will reduce. So that means it's because of the inflation. So option 3 is correct here. What is the real rate of return? Real, whenever, remember, there is a term called real, and then there is some sort of number you have to always think of, that this is inflation adjusted. Okay, so let's see where the inflation adjustment come in one of those 4 options. Return that investor gets after payment of all expenses, nahi. Next is return that investors gets after taxes, no. Third is return that investor gets after adjusting the risk, no. Next is return the investor gets after adjusting inflation. So that's option 4 is the correct one. What is asset allocation? Asset allocation, an investor's money in share market to achieve the highest return. No, that's not the asset allocation, because 2 things are problematic here. Highest return, no, highest return is not the objective. It can be a different objective, and it's only not share market. It can be any other financial market. Now second is allocate an investor's money to achieve the highest possible return. That's also not the criteria or right definition for asset allocation. Third, allocate an investor's money across asset categories in order to achieve the stated objective. This is the correct one, because it says you allocate an investor's money across multiple asset classes, where that asset class allocation across multiple asset classes is there to achieve the stated objective. So option 3 is the correct one. 4th is not, because it talks about safe return. What are the factors affecting asset allocation strategy with respect to an individual? The needs and the risk appetite of the individual. The answer is both. Needs of the individual as well as risk appetite of the individual is one of the key factors for affecting asset allocation. When the interest rate in economy increases, the price of existing bonds will drop. Always remember, when interest rate goes up in the economy, the price will go down, and when the interest rate goes down, the price will go up. The option 4 is correct here. The asset allocation that is worked out for an investor based on risk profiling is called tactical, fixed, flexible, or strategic allocation. It's always strategic asset allocation, because this is decided based on the risk profile. That's all for today in this particular video. If you like the video, please like and subscribe. I'll bring on the other chapters And once you go through those conceptual videos as well as the mock test, I'm sure you can clear the exams in a very first attempt. Thank you very much. Bye bye.